Morning and welcome. We're at the start of another fresh day of trade, Ankita, and couple of things that have influence over markets going into the rest of the week. Of course, one major factor is going to be the RBI policy.
Absolutely.
And of course, some inflation data as well starting to trickle through coming next week as well. So with that backdrop in mind, let's have a look at what global markets have been up to. Ankita, good morning. Talk to us about what global markets have been up to.
Good morning to you, Harsh. So the global markets, especially the US markets, they have hit their highs of 2023. They've extended the rally that came in after the debt ceiling news that came out, and yesterday also the S&P 500 advanced to a retreat, digested a recent rally that led the broad index to its highest level in 9 months. Now, the S&P 500 added 0.2%, trading near a 9-month high. It was also the highest close since August of 2022 apparently. And the Nasdaq Composite climbed 0.3%, also a closing high in 2023. Dow Jones Industrial Average eked out a narrow gain of 10 points as losses of more than 2% in Maersk and United Health weighed on the blue chip average. Now, Coinbase dropped more than 12% after SEC sued the crypto company, alleging that the company was operating as an unregistered exchange and broker, and that 13 assets listed on this platform were considered crypto asset securities. Now, remember, the suit comes just one day after SEC had sued Binance and its founder Changpeng Zhao. Now, in other news, according to the World Bank, US GDP growth is also expected to decelerate in 2024 to a 0.8%. Now, the experts have been penciling in a mild recession before this news came out. Investors will, of course, await trade balance data, as Harsh mentioned, a slew of data that is likely to come out through this week. But investors will be awaiting trade balance data as of today for the US markets. Now, coming to the European markets also closed higher, taking a cue from the US markets, with global markets lacking a certain clear direction, on the rate decision, which is, of course, due on the 13th and the 14th of June. Now, the Stock 600 is up 0.4%. The UK's FTSE ended the day 0.3% higher. Germany's DAX was up 0.1%. And Eurozone consumer data also came out that showed that consumers feel more positive about the inflation. And this was according to a survey that was conducted by the ECB. Also, consumer inflation projections decreased to 4.1% in April from 5% in the month of March. And from Germany, the manufacturing has dropped unexpectedly in April by 0.4%. So that's the roundup of the global handover coming in. Positive global handover coming in there, Harsh?
Absolutely. Or directionless.
Rather directionless.
That's the other way to put it, Ankita. And let's look at oil, right? Oil fell roughly 1% or thereabouts in trade yesterday. It's gained a little bit of those losses in early trade today, but really what's weighing down oil at the moment after over the weekend the Saudi Arabia or the Kingdom of Saudi Arabia cut production by 1 million barrels per day. So they've reduced their production by 10%. They contribute roughly 10 million barrels per day to the global supply, and they've cut that by 1 million. So we saw a bit of a spike in oil. It was at roughly 77. I'm going to try and zoom out and try and see where oil is at the moment. And thereafter, what's happened is there have been worries about a sluggish global growth, which could reduce energy demand going forward. So that was probably weighing down on oil again. And what we're seeing is oil prices come off. We've seen currently WTI below that $72 a barrel mark. Brent is just above $76 a barrel. From that $77 a barrel, it's a bit of a withdrawal that we've seen in terms of oil. But at the moment, unchanged is where oil prices are versus yesterday, or rather trading with a slight negative bias is how I would put oil. Really no movement there either. It's pretty much directionless even on the oil front, Ankita.
Right, Harsh, and also given the fact that we have the EIA crude oil inventory data that will be coming out today. Besides that, as I mentioned, we also have the US trade balance data that is likely to come out. And we have the Tata Motors AGM also that will take place today. And we have Tata Motors and Tata Communications Analyst Day. We have the Shipping Corporation of India's Land and Asset arm, which was they had demerged into their core assets and non-core assets, and non-core asset company was called the SCI Land and Asset, and that will be listing on the bourse today, which is going to help with the divestment that is going to take place for SCI very soon. And we have Maruti Suzuki Jimny that will be launching today, and that's a big competition for the Mahindra Thar. And we also have the OECD will be releasing its latest global economic outlook data. We also have UK's Prime Minister Rishi Sunak, who would be visiting the US President Joe Biden in Washington. And we have the draft bill for Digital India Act that will be up for consultation as of today. So these are the major events that we will be tracking very closely.
Right, Ankita, and we did speak about global growth, and that's where we'll focus on at the moment. While most analysts are slightly nervy about global growth, the World Bank has raised its 2023 global growth forecast. It now predicts the world would grow at 2.1% in 2023, while the earlier prediction was 1.7%. The US and other major economies have proven more resilient than earlier forecasts, but the global body also expects higher interest rates to be a drag on the economy next year. GDP growth in 2024 calendar year expected to be 2.4%, while earlier forecast was that of 2.7%. So they've shuffled between 2023 and 2024, and what they've done is they've front-ended that growth. The unexpected increase in the growth rate in 2023 has also been attributed to robust growth in the services sector in India. However, the World Bank also expects growth in South Asia to settle at 5.1% from 5.9% in 2023.
And another crypto exchange on the SEC radar. The Securities and Exchange Commission has sued Coinbase in the New York Federal Court, alleging that the company was acting as an unregistered broker and exchange. Moreover, the SEC also demanded that the company be permanently restrained. Stock closed sharply lower. Do remember, this comes a day after the same regulatory body unveiled charges against Binance and its founder.
Right, and global auto major Ford Motors has recalled as many as 125,000 SUVs and trucks owing to the fear of fires from engine failures. The company had earlier recalled 100,000 models in July last year on the back of 23 identified reports of fire and smoke due to block or oil breach in the engines.
And social media platform Reddit has also joined the bandwagon of companies laying off employees. The company has announced that it will be slashing almost 5% of the total workforce, or as many as 90 employees. Tech companies across the US have been slashing jobs after aggressive hiring trends seen during the pandemic years in face of an economic downturn.
Right, and in some other important news on the global front that we are tracking this morning, hundreds have been evacuated from the southern stretch of Ukraine's Dnipro River after water burst through the Nova Kakhovka Dam, submerging adjoining streets and town squares. In response, Ukraine has said that Russia has committed a deliberate war crime. Meanwhile, the Kremlin blamed Ukraine, saying it was a deliberate attempt at distracting forces from a Ukrainian counter-offensive.
And plane maker Boeing warns about a new defect in its 787 Dreamliner planes while flagging off delays in deliveries of the wide-body plane. A company assured that the said defect doesn't impact the flight safety and planes in service can continue operating. It is the near-term deliveries that will be delayed by about 2 weeks.
Right, and in other important news, the PGA Tour has agreed to merge with the Saudi-backed rival LIV Golf. In fact, Saudi Arabia has, in effect, taken control of top-level golf after the shock announcement of this multi-billion-dollar investment. The infusion could amount to about $3 billion and underscores how Saudi Arabia has muscled into global sports through its use of oil-funded state finances.
And artificial intelligence are set to take away jobs. That's a concern many tech experts have raised in the past, especially in the past year. So how does the space look like in India? Will we be able to learn to live with it soon? Well, experts chime in. Let's take a look.
Yes, it's going to take away some jobs, but I think India is at an advantage because there are many countries for whom there is a talent challenge, there is a human resource, looming issue going on, because of which they might have to lean towards it. But I think India can probably become a solution somewhere, and the talent in India in terms of mitigating some of these obvious costs of implementation of AI. So I personally am I'm a believer that yes, it's a threat, but it can also become an advantage for India in the days to come.
There is so many headlines coming out of the whole AI boom. One of them quotes the cognitive scientist who says that 80% of human jobs will be lost to artificial intelligence in the next few years. We don't know when those next few years are. Jaspreet Bindra, is this the conversation you're having with everyone right now? Is AI going to take my job? And what do you say to the point that Rituparna makes, that it's not going to be so easy, it's not going to be so quick, because at least as of now, in a market like India, human cost or human labor costs less than a huge tech overall?
Yeah. Look, if I was given $1 every time this question was asked of me, I would be nearing Sam Altman's net worth right now. Okay, that whether AI will take your job, my job, or not. Three things here. Number one, I don't believe that AI will take your job, but a human being using AI will. And that distinction is very important. There are a few jobs which sure AI will take, but those will be less than 10%, frankly, across the world, and lesser so in India. But a human being who learns to use AI well, and learns to use ChatGPT, generative AI, other AI well, will become so much better than an employee who does not, and will become more productive, more efficient, more creative. And that person could take your job rather than AI taking your job. That's number one. Number two is AI will impact tasks, not jobs. A job comprises multiple tasks, and there are some parts of those tasks, making a PowerPoint presentation, converting Word into some other format, stuff we spend huge amounts of time for. 60% of jobs will have an impact on the tasks within that. And again, then it's up to us how we can get better by using those, by letting those tasks be done better by an AI. Third and final is that, sure, some jobs will be taken away. Some jobs will never be taken away, especially jobs which involve compassion, love, construction worker, farmer, etc. But AI will also create jobs which we don't know yet. If you go back in history, and Sam Altman says this, in fact, and probably he'll say that tomorrow. If you go back in history, history will tell you that every new technology has come in. We don't know it. There's always a fear that jobs will go away. Started with the spinning jenny, steam engine, PCs, but eventually, so far, more jobs have been created than taken away.
Right, that's a very, very interesting conversation and perspective coming through. But with that, we'll slip into a very short break. More, of course, on the other side. We'll start going towards Asia. Right, welcome back. You're watching Market Cafe on ET Now. Let's quickly look at where Asian markets are at, flashing at the bottom of the screen as well. But quickly, the Nikkei is down 1% in early trade today. The Hang Seng is up around 0.8%, so positive across the board otherwise when I'm looking at it. The Shanghai as well, the Kospi is up around 1/3% or thereabouts. The Shanghai too is in the green, up around 1/5%, and you're seeing green on the ASX 200 as well. So broadly, mild green, but green nonetheless. Positive bias coming in from the Australian markets as well. Mind you, Australia is key because they have the policy rate announcement as well to keep in mind. So all of those coming up, we are looking at a positive bias coming through across the Asian basket. You're seeing the positivity trickling into the SGX Nifty as well, showing a positive start. 18,700 is the benchmark we're looking at least this morning, and hopefully it's a green, Ankita.
That's right, Harsh. Hopefully a green for us, since we had a positive handover coming in from the global markets, and Asian markets are also fairly in the green.
Right, welcome back. You're watching Market Cafe on ET now. Now, this week will be dominated more by our Reserve Bank of India and the monetary policy and how that sets the stage going forward into the rest of 2023. Reserve Bank's rate-setting monetary policy panel has started discussions yesterday. It's widely expected that the benchmark interest rates will stay unchanged at 6.5%. That's where the repo is currently at. The decision is expected on Thursday. We're now joined by Ankur Mishra, who's going to talk to us about what the expectations are from the MPC.
Yes, Monetary Policy Committee meeting has begun, and the wide expectation is that the repo rate may stay at 6.5%. Now, what are the reasons for that? You remember the CPI numbers had come, which is quite comforting for Reserve Bank of India. It was 4.7% in April, and before that it was well below 6%, which is the highest range for Reserve Bank of India's Monetary Policy Committee. Now, as far as MPC is concerned, they will also review whether or not they need to review the GDP target this time, because last time, remember, it was revised to 6.5% from 6.4%, but as far as the last year numbers are concerned, it has come better than the expectation at 7.2% for the whole year. So all in all, the eyes will be there whether or not there is a revision in CPI target and also a GDP target in the Monetary Policy Committee meeting, and also what are the announcements which this time RBI is going to make for banks and NBFCs.
And well, shifting focus, one of the world's largest venture firms, Sequoia Capital, is breaking up into 3 entities across the globe. Its China and US businesses to now function as separate entities. My colleague Bhavya Dua has more details on this news. Over to you, Bhavya.
Sequoia Capital, the venture capital powerhouse, is breaking up into 3 entities across the globe, splitting the Chinese and US operations as tensions grow between the world's 2 largest economies. The firm, known for its early backing of Google, Instagram and some of China's biggest internet companies, will split up into independent partnerships and separate firms operating under different brands no later than at the end of March next year. The company said, and I quote, "It has become increasingly complex to run a decentralized global investment business." More so, they added that this has made using centralized back office functions more of a hindrance than of an advantage. Sequoia over the years has managed tech investments across the Pacific, weaving in US endowment and pension money with opportunities in 2 of the world's largest internet markets. Now, as regulatory scrutiny in both Beijing and Washington escalate, the company is finding it increasingly hard to navigate the policy landscape. Sequoia was an umbrella brand for 3 already largely independent ventures, one focused on China, another on US and Europe, and third on India and Southeast Asia. The Sequoia China business will retain its existing name in Chinese and adopt the name Hongshan in English. Sequoia India and Southeast Asia will become Peak X5 partners. The US and Europe Ventures Capital business will continue to be known as Sequoia Capital. At the same time, Sequoia Heritage and Sequoia Capital Global Equities will operate under the Sequoia banner.
Right. Thanks for that, Bhavya, but we'll slip into a very short break. But before that, have a look at what Chetan Aya's outlook is with regard to the Indian as well as the global economy.
So look, I think the rupee is now, we think, more going to reflect what happens to the dollar generally against all the currencies. It isn't a country-specific challenge that will cause additional depreciation in the rupee. But if, look, the dollar rises, and that is the house view that we have, that the dollar will be strong in the near term, there will be that attended impact on the rupee and there will be some depreciation pressures. But fundamentally, on the country-specific aspects, we are not worried about the rupee outlook. I think to the extent to which dollar could strengthen, whenever there is a concern on U.S. recession, there is that flow of money that goes towards U.S. Treasury, and it strengthens the dollar. So that's the view of our global macro strategy team, that they expect that strength in the dollar with the concerns on risks of recession getting priced in the market. And unfortunately, during that period, there will be some depreciation pressures on the rupee, but it's not really a country-specific problem that will be causing that depreciation.
And what is your view at large, given that global financial systems across US and Europe seem to be slipping up, although well handled, and so was the debt ceiling? But what is the view on the US economy right now? Is a recession now inevitable? Are we talking about a soft landing, hard landing? What could be the contagion impact?
Yeah, so we are in the soft landing camp. We think US growth will slow. It will slow to 0.4% on a year-on-year basis by the fourth quarter of this year. But we think there are two key aspects of the US economy which are different in this cycle, and that's what helps us avoid a deeper recession. And number one on that front is that the corporate and the household balance sheets are in a very different shape. Typically what happens is you get to stall speed rates of growth, and then either the corporate or the household balance sheet defaults, exacerbating the downturn in the economy. So we don't have that in this cycle because bulk of the leverage pickup that happened in the economy since the trough of COVID crisis has been driven by government leverage rather than private sector leverage. And that's unique. That usually doesn't happen in previous business cycles. And number two is that the corporate sector has not overhired. You just saw the job growth number that came out last Friday. It was about 300,000 jobs added. And that's because the economy has been operating with some kind of shortage in labor. And so, when you are seeing this slowdown, the first reaction from the corporate sector would be to fire workers. But they're not doing that because the starting point is not at a point where they're overhired. So I think these two aspects makes us feel comfortable that the US should be able to achieve soft landing.
And what's the outlook in terms of the consumption trends as well, given that you have the full reopening as well of the Chinese economy? Are you looking at a consumption recovery playing out with a lag effect? How does that stack up versus India?
Yeah, so actually, usually most of the countries in the region move in tandem. But in China's case, in this cycle, it is lagging the rest of the region. And we have been using the developments in India as a sort of benchmark to follow for China. One thing which China is similar to India and rest of Asia in this cycle is that they have not taken up aggressive fiscal transfers to the households like US and Europe. And so the economic recovery on the consumption side is more organic. And so what we saw in India's case is that initially you tended to see pickup in services sector spending and then goods join later. And in terms of the income segment, it's the middle to high income segment that goes first, and then the low income to middle income segment joins the recovery. And you are seeing that in case of two-wheeler sales in India versus car sales. Two-wheeler sales are now looking like they are picking up. And there was a challenge in the initial period as soon as the recovery began in April 2022 last year. So in China's case as well, we think something similar is happening. Right now, services sector PMI is looking strong, but the goods spending has not picked up as much, and so therefore the manufacturing sector is not yet strong. And the higher to middle income segment has first taken off. So if you heard the results of luxury companies, luxury goods segment companies, multinationals, they all felt that they had good uptick in China sales, but the mass market products has not yet still seen that full recovery. So we think China's consumption recovery is on track if you wear this lens of analyzing what happened in rest of Asia. And I think by the time another 6 to 9 months, you will have more broad-based recovery in China as well.